If I was starting from scratch and wanted to buy my first home in 2026, knowing everything I know now after helping hundreds of first home buyers, this is exactly the step-by-step process I would follow. I'm Kuan. I'm a mortgage broker and I've been on both sides of this. Back in 2009, I bought my first home and made almost every mistake you can make. I walked into a bank, spoke to one guy with nice blue cufflinks, got one pre-approval and thought I was ready. I had no idea what I was doing. I did not understand what LVR was. I did not understand how much cash I actually needed to complete the purchase. I did not know about stamp duty, settlement, adjustments, or conveyancing fees. And on settlement day, I was 20 grand short. Since then, I've worked in commercial property research with CBRE and Colliers. I was a buyer's agent, worked as head of credit at a non-bank lender, and now I help people navigate exactly what I wish I'd known back then. So today, I'm going to walk you through the exact process I'd follow if I were buying my first home today. The first thing I'd do is figure out my real budget. Now, it's not what I think I can afford, it's not what the bank says I can borrow, but what I can actually handle week to week. And here's how I would approach it. Let's say I can comfortably afford $1,000 a week in repayments. At the current rate of 5.5%, that means I can service a loan of about 760 grand. Now, let's say I've got 100,000 in cash. My total budget would then be $860,000. But that's not my purchase price because I need to account for all the costs. Stamp duty in Victoria, it's about 5.5% on properties over $750,000. If I'm using a buyer's agent, that's another 1 to 1.5%. Then there's conveyancing, inspections, government fees. I allow $2,000 for conveyancing, $1,000 for lender's fees, and $5,000 for contingencies. The contingency covers building and pest inspections, settlement adjustments, and whatever else that comes up. So my total costs are around 8%. That means my actual purchase price is $860,000 divided by 1.08, which is about $800,000. This is critical because most people work backwards from what they want to spend, not what they can actually afford. They fall in love with an $850,000 property, then scramble to find the extra 50 grand they did not budget for. Once I know my real budget, I'd apply what I call the triangle principle. Between location, property type, and price, you can only pick two. If I want the perfect location and the perfect property type, I'll have to pay more. If I want the perfect location at my perfect price, I've got to compromise on property type. And if I want the perfect property type at my perfect price, I'll have to look further out. I see home buyers spend months trying to find all three. They want the renovated 3-bedroom house in their ideal suburb for their ideal price. It often does not exist. Meanwhile, they're getting priced out because every month they wait, prices are going up. The smart approach is to decide up front what you're willing to compromise on. Maybe you'll take an unrenovated place in your preferred area. Maybe you'll look at a townhouse instead of houses. Maybe you'll go one suburb further out. Now, once you know your budget and what you're willing to compromise on, the next question everyone asks is, how much deposit do I actually need? Contrary to popular belief, you do not need a massive deposit. The minimum is actually zero if you have family who can guarantee the loan with their property. This includes mom, dad, brother, sister, grandparents, or foster parents, as long as there's a genuine reason for them to be your legal guardian. Basically, the bank lets you borrow against their security for purchase as long as you have the servicing capacity. Next level up is 2% plus cost if you're a single parent under the guarantee scheme. And then it's 5% plus cost if you're a first home buyer or you haven't owned property in the last 10 years. Now, obviously, the smaller the deposit you pay, the bigger your loan and the more interest you will pay over time. But for some people, getting into the market quicker makes more sense than waiting years to save a 20% deposit while prices keep climbing. Remember, your deposit is just one part of what you need up front. Like I explained in the beginning of this video, you need to make sure you have budget for stamp duty, building and pest inspections, legal fees, settlement adjustments, relocation costs, and the potential overlap where you're paying rent and mortgage repayments stacked together. Thankfully, you can make use of some of the stamp duty concessions to reduce some of your upfront costs. For example, in Victoria, you won't pay stamp duty if the property value is below $600,000. And you get discounted rates for properties between $600,000 and $750,000. You could potentially also apply for the First Homeowners Grant, which is in most states a $10,000 grant to help you pay some of these upfront costs. If you're stacking all these grants and concessions along with using the 5% deposit scheme or having a guarantor, you could significantly reduce the cost of entry to buying a property. Once you have your budget sorted and you know what schemes you qualify for, the next step is getting your finances lined up. Here's what I do differently with pre-approvals. Most banks don't do fully assessed pre-approvals anymore. They just run automatic checks based on what your broker tells them. The difference matters because if your broker gets something wrong, the automated pre-approval will also be wrong. A fully assessed pre-approval means a human has actually verified your information and checked it against bank policies, at least 80% or 90%. But here's the thing, if your income is straightforward and your broker is experienced, you may not need a pre-approval at all. I tell clients with simple situations that I'll back them up as a broker, speaking from 12 years of experience, processing over 1,000 applications, and being head of credit myself. But if there's any complexity, get a full assessment. Either way, a pre-approval is always subject to valuation and subject to your financial circumstances not changing. Typically, it's valid for 90 days, and after that, they run another credit check. But in the first 90 days, they have every right to ask for your bank statements and income statements again. If something's changed, the first pre-approval does not stand. If the valuation falls short, or if the property is not acceptable to the lender, you still can't get formal approval anyway. So in the real world, you're still taking a risk either way. The key is managing that risk. Which brings me to how you actually execute in this market. If I was buying today, speed would be everything. But speed without preparation is just panic buying. The smart approach is to decide up front what you're willing to compromise on. Going back to that triangle principle, location, property type, and budget, pick two. Make peace with what you're giving up before you start looking. First home buyers often think whatever decision they make right now is set in stone, but it's not. It's temporary, it's a stepping stone. Your first home does not have to be your forever home. Whatever fits you now from a lending and product perspective is fit for purpose today. But when your circumstances change, like when you get a pay rise or you've built up equity or your family situations change, you can refinance, restructure, or sell and move into something bigger. The goal is to get in while you still can afford it and while building equity as the market moves, while your loan balance reduces. Now, once you've found a property that fits your criteria and you're ready to make an offer, how you negotiate matters. When it comes to negotiating, I focus on more than just price. Sometimes vendors are motivated by other factors like timing, certainty, and convenience. If I could offer a 14 or 120-day settlement instead of the standard 60 days, that might be worth 10 grand to a vendor who's trying to buy the next property. If I could make an unconditional offer because I'd done all my due diligence up front, it would remove the risk for the seller or beat other competitors who aren't ready to make offers yet. Another thing to keep in mind is the bigger picture. If I'm paying 10 grand over my budget on a $1 million property, that's 1%. If the market's rising quickly and I've bought well, I could make that back in potentially 3 to 6 months. But if I miss out and have to wait another 3 months while prices keep rising, that could cost me 30 grand or more. Now, before you make any offer, whether it's with conditions or unconditional, you need to do your due diligence. There are 3 things I would never skip: legal review, building and pest inspection, finance confirmation. This is especially critical for auctions because they're unconditional. I've seen people lose deposits because they bought properties the bank wouldn't accept as security. I've seen bank valuers discover major structural issues before formal approval that might cost them $50,000 to fix. The worst case scenario isn't just losing your deposit. It's being stuck in a contract for a property you can't settle on. That's when you're looking at legal action and potentially losing everything you've put in. So get your building and pest done before you sign anything. Get your contract reviewed by a conveyancer or solicitor. And make sure your broker has looked at the property and confirmed the likelihood of the bank accepting it as security. Once you've done all that and your offer's been accepted, you're on your way to settlement, the exciting bit. In the week before settlement, there's a few things I recommend you do. First, I'd have settlement funds ready with a buffer. If the calculation says I need 53 grand, I'd have 60 available. Second, if I'm transferring money to an agent or solicitor's trust account, I would call them directly to confirm the account details. Third, give yourself time. If you're transferring a lot of money into your settlement account, allow time because sometimes it just takes time. Fourth, get your building insurance sorted immediately after signing purchase contracts. Because honestly, if anything happens between the day of purchase and settlement, you don't want to be stuck in that contract arguing about who's legally responsible for damages or whatever that went wrong. And the bank will eventually want it at settlement anyway. Your mortgage broker will work with the bank until it's formally approved. Then your conveyancer will take over and get everything ready for settlement. On the day of settlement, they'll direct the funds with the bank, and once it settles, you pick up your keys. So there you go. the exact process I'd follow if I were buying my first home in 2026. Now, you might be wondering where to start with your specific situation. Maybe you're thinking about your budget, or which government schemes you qualify for, or whether you should get that pre-approval sorted first. Everyone's circumstances are different. Your income structure, your deposit amount, your family situation, and the areas you're targeting all affect which strategies make the most sense for you. That's why we offer strategy calls where we sit down and map out your exact situation. We look at your numbers, work out what you qualify for under the different schemes, and show you what's actually realistic in the current market. If that sounds helpful, there's a link below to book a time. Otherwise, make sure to subscribe and I'll see you in the next one.